We were trying to buy another 22-unit property next to it at the same time, because how this was set up, what happened was we bought a 32-unit, and then we bought 27 quads and one threeplex around the property with the office and everything. We thought the whole thing was like, oh, we'll sell it as one.
Yo, what is up, everybody? My name is Matt Drouin, the host of the Go Big Live Real Estate Investors Podcast, the show to tune into if you are an experienced real estate investor, owns maybe a couple duplexes, and knows that they have to scale into larger commercial real estate, whether that be multifamily, industrial, self-storage, medical office buildings, you name it, and mystified by the process. We bring on stories of active real estate investors and the stories that they did to do their first bigger deal. It was big for them. I'm super excited, psyched out of my mind to have Mr. Charles Carillo on the podcast today. He is founder and managing partner of Harborside Partners in 2006. He has been involved in over $200 million worth of real estate transactions and has extensive knowledge of renovating and repositioning multifamily and commercial real estate. In addition to being an active investor, Charles passively invests in many different asset classes, including commercial real estate, early stage technology, and that'd be cool to talk about a little bit today, and agriculture, ag tech startups. Charles oversees all acquisitions, investor relations, and strategic partnerships with Harborside Partners. He is also the host of the popular podcast Global Investors, so definitely check that out. It's on YouTube. I believe it's probably on all the podcasts where you get them to. Has a ton of educational content on his YouTube channel too, so definitely tune into that. And on the podcast, Charles interviews successful real estate investors in addition to his weekly strategy episodes. And prior to launching Harborside Partners, Charles co-founded an online payment processing company that has since processed over $1 billion in payments for clients in 5 continents across the globe. Charles is an Eagle Scout and holds a bachelor's degree from Central Connecticut State University. Jeez, man, that was a mouthful, man. Thanks for coming on the show.
Thank you so much for having me on, Matt. It's awesome to be here.
Excellent. So first question, man, is a loaded one. You were born, now you're here. What happened in between?
I was born in Connecticut. I lived there until 2012, and then I moved down to Florida, where I am now. I'm in South Florida, Palm Beach County area. So I lived a couple places in Florida, but this is kind of where my wife and I are now. And I grew up in the real estate business. My dad, a few months after I was born, my dad bought his first multifamily property, a 6-unit, and that was at the end of 1984. And he self-managed that. And then he went on and built over the next 15 years, him and some of them with his partner, no syndications, they built about 100 units in a portfolio, and they started selling it out in the late 90s. And those properties were very management intensive. They were D and let's be nice, C- properties, but extremely difficult properties. And that was one thing that I grew up with my dad going to those properties twice a week and dealing with superintendents and dealing with brokers and dealing with a lot of superintendents, a lot of tenants collecting rent door to door. And my dad had a small team that he managed it, but you can't really manage effectively that great of properties with a management company. So that was a lesson, and it really taught me that I don't want to do this. And then you start kind of understanding, putting pieces together, I guess, when you get a little bit older, and you start seeing kind of the freedom factor with it. And then when I got interested in it in high school, my dad started bringing me around more to different places and learned the other side of the business, which wasn't property management, which was actually buying the properties and dealing more high level. We went to went to court to evict people, all the kind of stuff that you have to do, and met with a lot of lawyers and all that kind of stuff. And so learned that side of the business. And he taught me buy better properties, and he started doing that, took his own advice later in life as well, and that's kind of where he is now with his own portfolio of properties. But it's just one of those things that that's kind of what I did when I started buying, was that I remember bringing him properties, and he'd be like, oh, no, these aren't. He's like, you don't want to be in this neighborhood. You don't want to be in this. You don't want to be that. And I realize that now the people that because a lot of investors, real estate investors initially, are only cash flow looking, and they're looking and they just get brokers know exactly how to push that new investor, and it's about just tweaking that cash on cash number or giving that high cap rate number, and people are like, oh my God, this is so easy. Why isn't everybody doing this? But I guess what I've realized is buying better properties, better areas, you're going to get a mix of that cash flow that everybody likes, but with also appreciation. And the one thing about good properties is there's always going to be a buyer for them, and it's a much more liquid asset than terrible properties where you're only going to be able to sell them in hot markets. And that's that's what I've really kind of found out over the years of doing this, and bought my own first property in 2006, which was a 3-family property, and then bought another one a couple years later at the end of 2008, which was a very interesting time in real estate. And then 2009, I bought a small mixed use. It was like a 5-unit mixed use property, and kind of grew from there. Bought other stuff, but 2009 there was just no financing. Had to buy in cash, and properties were on the market for many, many months. This one was all vacant, and I started buying properties from there. I self-managed them all. I bought some with my brother as well, and then we sold that whole portfolio in 2022, at the beginning of 2022, to an investor out of the New York City, because these were all based in Connecticut. So,
excellent. So, were you running this business sidecar to a full-time, demanding job while you were building this thing, or what?
I'm in a kind of a lifetime entrepreneur. My last job was a busboy in year 2000 at an Italian restaurant, and I started that payment processing business, Matt, that you mentioned earlier, in college, and that's how I funded everything. It was just you make money and then you buy property, and you make money and you buy property. And I wish it was more strategic than that, but it wasn't. And that was I think that's how a lot of investors started. I just kind of started like most, I guess, active real estate investors. And I was self-managing them. Toward the end, I self-managed for 6 years, and I was getting to the end, closer to 2012, when I gave all my properties over to a third-party property manager at that point. And then I really found out what real estate investing should be like. And but I mean, during that time, I started giving away more tasks here and there. But obviously, you do all that stuff earlier. I could have been spending more time, instead of dealing with tenants and all that stuff, buying property, raising money from investors, which was much harder back then than it is. I guess a little harder now than it was a couple of years back. But no one was giving any money away in 2009. Everybody was burnt, licking their wounds. And a famous story is I renovated a property that went to a bank I had a relationship with, my family had a relationship with, for about 10 years. And they offered to refinance the property that I owned in cash. It was all renovated, fully rented, and they're going to give me a 15% loan to cost on that. So that is what lending was like. If people have questions about what lending was like in 2010, that's exactly what it was like. And that's why there's deals, because there's no money. And that's how real estate, another thing I learned is that how real estate works is off of lending. As we learned too, most people that owned any real estate in 2006, 2007, 2008 is when that lending dries up. I mean, that's the lifeblood of this capital intensive thing of real estate.
Yeah, it's definitely the tail that wags the dog that a lot of people don't even really understand in terms of how this financial systems and financial markets create these systemic outcomes that we have to deal with. And it's kind of interesting because you and I got our start in real estate at the same time. I started in 2006, bought my second in 2008, and that's when I got bit by the bug, and then witnessed when the Fed funds rate skyrocketed, and you could get 5.5% interest on a FDIC insured money market account. So it definitely just rippled through the entire capital markets and created a lot of opportunities. But it's one of those things. Probably you and I could agree that we should have bought more or figured out how to buy more during that time. But so Charles, I want to jump into the case study we were talking about in the green room that we kind of want to pull apart and go into excruciating detail on. And it was the first deal that you had done. You'd done a syndication on it. And the reason why we want to pick this one up and really take a good look at it is that you were buying a deal, and then midstream COVID hit. So tell me about the origin of that story, or even backing up, what was the leading up to, okay, all right, I'm going to syndicate something. Was it the first time you did that, or what?
Yeah, so I had a mentor. I never wanted to take money from people. I was just like, oh, it's one more thing I got to deal with. I was like, buy property and, make money from my online business and invest in the real estate. Same thing, just keep on doing this, and I'm going to do this. I saw some wealthy people in the town that I was doing that's attorneys. They had really high paying jobs, and then they built up real estate portfolios, had their own management companies. Really, I'm like, oh, that's awesome. That's a great way of going about it. And then I had a mentor I spoke to in 2017, and he was just not my father, a mentor that had syndicated properties. And he's like, you're just never going to scale if you don't take money from other people. So that was a kind of a life lesson there. And I I kind of starting in 2017, end of it, 2018, I kind of changed around what my goal was with Harborside Partners into more of doing syndications, where I was just going to be before focusing really on doing flips, you know what I mean, and to generate more money to buy property. And so that was a whole thing, and it took time. It took me a few more months to realize that you need to bring on partners, which I was really against doing. I'd only really worked with my brother, and which we still work together now. We're co-owners in that payment processing. He handles that full time, and it's something that it allows you really to really hone in on what you're best at, you know what I mean, and focus there. And that's a very important factor. So I really got aligned with the group. It was like early in 2019. The first deal, like when we were speaking initially, the first deal we had, which was 59 units, that one we closed before COVID, but then COVID hit like a quarter later and a couple quarters later. So we did another one in 2020, which was during COVID. Like we closed on that in July. So we were supposed to close down in June, but we closed in July, and that was a whole different ballgame. But the one we did in 2019, it was 59 units in Tampa, and we ended up selling it in 2022. We sold it in 2022. And so it was just about 3-year hold on that property. And I mean, everything was going fine. We were doing payouts. Everything was going great to investors. And then COVID hit, and no one knew really what was going on. And then we had like GP meeting, and we're like, let's just pause, let's pause distributions. And it was much easier than I thought it would be talking to investors, because investors, everything was melting down, or we thought everything was melting down at that point. And the conversation was much easier than I thought, because they pretty much were like, oh no, we were aware of that. Like, hey, our goal is like to keep the property and like keep everything going. And we were very lucky. We had a lot of blue collar essential jobs. And it's funny how every pullback is different, because if we owned the same properties with the same tenant clientele in 2008, where it was construction based, a lot of, like say you're down in Florida and you have a lot of construction people, that's where Florida really got burnt in that time. All those people would have been paying their rent in COVID, right? But they weren't paying their rent there because there was some sort of, we don't have to get into politics, but something happened and chose who could work and who couldn't. So the thing that was that in that situation is that it's interesting how every pullback's a little different, but still fundamentally there's similarities to everything. But so that was another thing I learned in real estate. And it was difficult. We raised that money for the first deal, and we had general partners with us. And I was like, okay, I'm bringing this amount of money to the table. Then I had investors on our first deal, and was like, that we were working with, and I should have been more thorough about what their investors look like. And they literally had like 1 or 2 large investors. And obviously they backed out, you know what I mean? So now we were scrambling like weeks before to kind of close the deal. And it was just like dragging out. And we got it closed. I wasn't even in the country at the time. I was traveling to see my wife, who was working in Hong Kong at the time. And I was actually seeing some virtual assistants in Nepal. So I get a message, and they're like, hey, like the deal's closing, you have to sign this paperwork for the lender and get it back to them. And I was like, I'll DHL it back and give you a thing. I'm in Nepal. So I had to go to DHL. They drove me, I went to DHL, which wasn't really happening. There's just 2 guys with their feet up on their desk, and walked in with my assistant, who spoke Nepalese, and was like explaining everything. And he was like, I just filled out these documents, sent them back to the United States. And so I closed my first syndication from pretty much a third world country. Nepal's a great country, but it's a little behind other countries. And it was, and that was the start of the ball for our active investing. And did another deal, and we knew that area so well. That's what made it more confident for us to do, because it was only like a block away, the second deal we did during COVID, and the year later. And that deal was intense. It was much easier to raise money for that deal, because you had I was like, hey, this is much better, because you go to investors and you're like, hey, this is what we paid last year, and we're paying 2% higher or something like this for a property that's much better. You know what I mean? It was like, you could see, and I could just see, and you're like, oh, this is like night and day. You know what I mean? Like, this is a no-brainer. You know what I mean? And then when you're that confident with investors, it really, you're putting your money in there, you put, all your family money, all that stuff in there, and you tell investors you're meeting with them at the property. And that wasn't that difficult of a deal to do. But the first one, getting that proof of concept, because I mean, who's going to invest with a new syndicator? You know what I mean? I won't, you know what I mean, unless I was active in it. And, or I mean, it was something I really knew, but you had people that are asking you for years, which I imagine you did too, Matt. You know what I mean? When you started, you were talking about it and people asking how they can get involved. And I heard that for years. And I was like, oh, I don't know. You know what I mean? Because like, I don't know how you would get involved. You know what I mean? I wasn't really too in tune to what was going on with syndications. Then when it came out, I was like, okay, like I have a list of people I can now reach out to, and most of them will fall through the cracks, but you'll find some that will actually want to invest with you and actually go all the way. And that's the big thing for, I think, new syndicators too, is, hey, just because someone told you that they're going to invest when you're having a beer with them, it's much different when you're like, it's Tuesday morning and they get the OM email to them and you're like, hey, let's get on a call. You know what I mean? Or, you know, then it's like, whoa, what is this? What are you doing? What happened? You know what I mean? And, so like you really have to count people accurately that you speak to when you're talking, because you're going to bring that to a group you're working with. And it was like the same thing that happened with us. You know what I mean? And I should have been more knowledgeable and been like, is this like this $500,000 you're bringing in? Is this like 10 investors or is this 2? You know what I mean? And I didn't ask that, but it was something, you know, we scrambled to get it to close, but it's that's not the best way. It's the worst way to raise money, because people can just, the people that invested with me were ones that really, really knew me. You know what I mean? It wasn't someone else picking up in a meetup or something like that. That was like, oh, hey, you know, put in second, third deal. That's when you have people from meetups that were like, okay, I'll invest with you. And they had like a professional relationship with you because of what you've done or what happened. But yeah, that's kind of those first 2 stories around COVID and kind of how we got the ball rolling as active syndicators.
So Charles, one key takeaway is always bring your wiring instructions to the bar. Always. All right. Yeah. And that's the one thing too, is that, you know, I have clients that are doing their first bigger deal, and, you know, there's the 2 bottlenecks, right? There's the deal flow bottleneck and the capital bottleneck. And a lot of times, like, hey, how are you doing on the OPM side of things? It's like, oh, I had coffee with somebody who's like, he's just the one guy or the one girl that's gonna follow. I was like, don't stop there, because they could get hit by a bus, they could have a tragedy in the family, they could just figure out, damn, that person's annoying and I don't like him anymore, and then it just wrecks your deal. So you kind of have to keep that bottleneck expanding and deepening and cultivating that network. On the deal flow side of things, Charles, how did you find this deal? Because that's the one thing that a lot of people that are trying to swim upstream into larger commercial deal space that they struggle with. So let's dive into that.
Yeah, just one thing before you said that is what you were just saying is, and I'll add one thing to it. And it was from my lawyer, so obviously it's negative, but it was just something that you can have a large investor that comes in that wants to take control of the deal. They call it the whale. You know what I mean? So that's another negative thing about having one large person, because now they can rewrite the rules, 23rd hour type thing, and be like, hey, this is what's happening. And luckily I haven't had that issue, but apparently lawyers are worried about everything like that. So that's one thing that could also be aware of. Hopefully your family member wouldn't do that to you, or a good friend. They would just not invest. But how we found the deal is it was through a local broker. It was a national broker that we were working with, but just our local office. And one of my partners had built a good relationship with, and they'd already bought some properties local there. This was my first property in this market. This was in Tampa, myself. But I was living in St. Pete with my wife at the time, and we were. So I was very familiar with like Tampa. I could drive there, see everything. I walked every of those units. We were trying to buy another 22-unit property next to it at the same time, because how this was set up, it was not to make it any more difficult, but what happened was we bought a 32-unit, and then we bought 27 quads and 1 3-plex around the property, right? So we had a 32 with the office and everything, and then we bought these smaller properties around it, and we sold them off in parts like that. We thought the whole thing was like, oh, we'll sell it as one. But what we did was we sold the 32 for a much higher, because people like that. That got a much higher return. And we sold the other ones to like a dental investment office or something, investing group. It was from a local broker that we'd built up a reputation. You had someone that had properties in that area that was on your team. Because having properties out of there, people kind of, it's not as powerful. Whereas if you're in the market, or even, Florida's huge. So, but like in the county, let's say, you know what I mean? That adds a lot more has a lot more behind your offer and behind what you're willing to do, because they want to just make sure you can close, and they'll go to bat for you. Like I've had like mortgage brokers that knew you could close, and you're just trying to put together everything with your lender and stuff like this, and they're like talking to, pretty much conveying to the seller, hey, they're going to be able to close, blah, blah, blah. They're going to bat for you. And you want to have a broker that's going to do that. And to do that is to make them, it's like I was with that second deal when I was very confident bringing to investors. It's like, if you're very confident with that you can close, that you have the funds, that you have the expertise, because they want to resell this for you too. I mean, if it goes into foreclosure, it doesn't help anybody. You know what I mean? They're going to ruin the relationship. I mean, everybody's trying to make a little bit of money off the whole process, and they want it twice. So they want you to sell through them, which we did. You know what I mean? Just like when we used to flip property, small properties, we'll sell it through the same agent that we'd buy it from. But it would be something that, so they want to make sure that you can do everything, right? That you can close, number one, so they look good to the seller. And then number two is that you're able to do it, and they're hoping in 3 or 4 years to sell it from you again. I remember when you're walking, they're like, "Oh, you're going to sell this thing for so much in years to come." I'm like, "Oh, yeah," and we actually did. But it's not like he foresaw COVID. He was just a very growing area of Tampa. But yeah, that was it. It was local brokers. It was going in there with a resume that was local, that showed that we bought these properties, people on our team have, and that we could definitely close and renovate the property.
So, what's your words of advice for investor out there maybe owns a couple duplexes and they want to be in a position to buy a 20, 30 unit apartment deal, and they don't have that, for instance, but broker is going to be an instrumental part in their growth and the deal flow side of things. So like, what would be your words of advice for them in terms of how to reach out to brokers, how to really build that deal flow side of their equation?
Dealing with brokers is much easier than you think, even if you have smaller. I think people make this much more difficult, and it's like the broker's all on commission. Obviously, a lot of these people that you're dealing with in this industry are all on commission, and so from your lenders to the title people, I mean, if you don't close anything, they're not getting paid. So a thing that was that you can build a relationship and start the relationship off the broker, and a lot of people do. However, a lot of people don't complete it. The majority of people don't, and that means that when they do send you a deal. So, you know what I mean? If I'm a broker and I go to have coffee with you, Matt, or I talk to you on a phone call, and they say, "Oh, you really do want to buy, a 15-unit property." Well, I have one, and it's off market, and it's 16. It's going to come on. Here it is. Here's a link to it that's not live yet. Review it. And most people, that's it. Most investors, they won't go through in it. So it's really important that you have your whole cycle of what you're going to do when deals come in. And this was one thing we had when we would direct mail properties, and when they'd come back in, we didn't have like a solid underwriting arm of it. When we'd buy like JV like small local properties, and once we got a good underwriter, then it all worked, because now, hey, when it comes in, I can review it right away. We know exactly what's going to happen. Hey, this person's going to review it right away. I can then get on the phone right with them and tell them this is what's happening, if they want to get into numbers right away. Most of the time you're building rapport, but when you're dealing with the brokers, they want feedback. And even if you're not going through it, they want like a quick response saying, "Hey, this is why I don't like it. This is one thing hey, this is too old for me." Because if you say your box is 1980 to 1990, 10 to 20 units, they'll send you something that's 9 units, that's 1979. I mean, they'll just kind of see where it is. And if you're really hard to the fact, which maybe I would still look at that property, but the thing though is that they're going to find anything that's close to you and to like test you out. They just met you and they want to keep the relationship going. So I think a lot of investors don't do that. They don't follow up and like, you've done the beginning work to it, but you're not a true buyer, right? The other thing too is once you start getting into larger commercial properties, when you're dealing with smaller like multifamily properties, they're used to mom and pops, people sending emails from Gmail accounts and all this type of stuff. When I spoke to brokers, I have a broker that I know here in Florida, and I would ask him like, give me some of the things that show that someone's like serious, and they would tell me like the email address coming from, and they're like, and he like actually. He actually graded it for like 6 months or a year. And he was like, these are the deals I've sold. Deal size, he had like 3 different deal sizes, and like how they came to me. So it was like just like AOL address, some sort of business address, not with real estate, which was a little better. They closed more deals. And then someone with like a real estate website with a real estate, you know what I mean? And it doesn't have to be like a 1,000-page website, but it can be like, 5 pages. I mean, he's not going in that depth. It's just like, that's how he broke it. And he found out that the people with the website that was actually in real estate, you know what I mean, were much serious buyers. And then he could zone out and figure out exactly. And we did the same thing with like payment processing. We'd have like, when through our CRM, when we would set up stuff like that, we'd know exactly when stuff came. We'd know exactly how many, hey, this never pans out. You know what I mean? Just like stop dealing with this one if it doesn't pan out. You know what I mean? So when you talk to like working with assistants and your account managers and stuff, you'd be explained to them, and it would be like, okay, this is like a no-go. You know what I mean? Don't waste your time here. If they come back to you, it's a different thing. But if I wouldn't spend your time on your daily follow-ups through here. And that's gonna be the same thing it's the same thing on the broker's end. So I think, first of all, before you start raising money for deals, you do deals yourself, no matter how small they are, and proof that concept for yourself. But also now you can provide that and put that into your nice, booklet when you go meet the brokers, no matter how small it is. Bring them like a nice printed color brochure, or have it like in a PDF that you send to them before you go out and meet with them. Have the website, even if it's 4 pages, 3 pages, doesn't matter. Add to it little by little. And I think these are the ways of building that relationship, and then also actually have a real plan when they come in. And I would share that plan with brokers, because if you respond and you're like, hey, this is why I don't like it, it's too old, it's I don't like this type, I think like the management numbers are off. And I've had that before where I've said that, and then they come back like, oh, we got a quote from management from this firm, and you're like, oh, well, we want to use this firm, it's gonna be more expensive. They're like, oh, okay, and they'll go from there. But it's like, that's true feedback that they now can share with their seller. But also you're gonna get more deals from them, because there's gonna be a lot more of people that went to a weekend conference or something that were like, oh, well, they just told me this part. They didn't tell me like this end part. They told me like how to talk to them. I did. And like when do I get the deals, or when stuff, like, do they underwrite? You know what I mean? So I think that's a very important part. So that was a great question. Sorry if that's really long-winded, but.
No, there's a lot of actionable stuff out of there. I mean, I think that, the number one complaint I get from investors is, there's no deals out there. The brokers don't send me anything, and I'm on the other side of this thing too, because like I'm a former real estate broker, and I'm also friends with a lot of them. And the brokers name these investors, they call them Caspers, as in Casper the Ghost. And they send, they take the time to send them over the offer memorandum and all this sort of thing. And what do you think? And they don't do anything with it. They don't underwrite it, because it's almost like some people are like a dog chasing a car. Like they wouldn't know what to do with it if they actually got it. Right. And it's an extreme undermining thing with your credibility doing that. And I think don't you think like it's when somebody says hi to you, like then you say hi right back? It's like there's this like reciprocity thing where there's an expectation of response, and the button that turns the light on is the button usually gets pressed, right? So if somebody says hi to you and then you're like a quarter mile down the street and you say hi back, like it doesn't have the same effect. So now, this was a gut-wrenching deal with the large investor, 2 large investors pulling out of this. You probably thought it was going to be smooth sailing, and then all of a sudden you're like, oh crap, like we're in trouble. Like tell me that war story.
Yeah, so it was just, I had 2, the partner I did a handful of deals with, and we have a much better relationship now. But I mean, we had a good relationship there too, and everything was fine. But it was just naive on my own end, which was like, I should have gone and like, we were just like talking generalities, right? We were like having coffee. I walked the outside of the properties, and then they're like, listen, do you want in on this? Blah, blah, blah. Like, we need to be sending money into the lenders for fees. And then in the generalities, it was like, all right, I'm going to bring this amount. Like, I already knew up front. I was like, all right, I already like had everything kind of firmed up, and I'm like, this is what I'm bringing. And then we went around like the cap table kind of a thing on like phone calls. And, it was like, okay. And then when they're like, hey, these like pulled out, it was like, we had like a general partner that they knew that had pulled out with these 2 investors. And I was like, oh man, like this is, okay. So I had, one of my partners I had brought in that I was working with, and he was like, all right, like, let's just like do it. And like, let's call like 100 people. Called and emailed like 100 people, everybody I knew. And I was like, if somebody I knew had a heartbeat at some point, they're getting an email or call from me. And it was like everybody. And it's terrible. It's a terrible way of doing it, and you feel kind of dirty doing it. But I mean, I was like, I already got like 50 G's into this thing. I got like another 100 I'm putting in, I said, like, or whatever. I'm like, I got friends that already wanted money. Like, you know, we're closing this freaking deal. You know what I mean? Like, no one's losing money on this. And I know it's a good deal. And yeah, you have to really just set aside time and do it. And a lot of no responses and a lot of emails that a lot of, you know, getting on phone calls with people and trying not to express how fast you need the money. You're like, oh yeah. You're like, you know, because now it's one thing when I talk to investors, I'm always like, okay, like this is the goal. The goal is like to get you paperwork and like have the decision within 2 weeks and like have the funds within a month. And if anything comes up sooner, like, it's desperation. Like I just got a text message this morning from someone, a syndicator I know, and they're kind of like, oh, they need the money within like a week. And you're like, for a deal. And you're like, no, I appreciate the opportunity, but I'm going to pass. Like I don't even want to see the deck. Like I know exactly how these things go. I don't want to passively invest in that. I don't want to invest in that. And I'm definitely not bringing other investors into it. So these are like kind of rules you kind of come up with where you're going to have enough time to do your due diligence. And in the beginning, you're going to do stuff that's going to push stuff a little bit more riskier than you should. But if you kind of know that the property cash flows, you have long-term debt on it, which we did in these properties, fixed debt, and you have a reserve fund, you've really lowered the risk to really, other than paying cash for the property. You know what I mean? Like you can only lower the risk so much with having debt on it, but that's one way of really lowering it where people are actually going to make a double-digit return. You know what I mean? So I think that was some of the things we just called. We called a bunch. We emailed a bunch. A couple different conferences I've been to, we found 2 investors out of there, and 2 main ones that really made up for that. But and a couple other small ones. But yeah, it was just like a ton of calling around, finding people that want to be part of the deal. And that's always when I tell people, if I'm coaching someone now, it's like first deal, when you're like, first of all, when you're grading investors, just grade them much lower than you thought. You know what I mean? Like we said before, a Tuesday morning call different than a Friday night call or a meeting. And then it's also, the other thing too is just mark out when people are giving you, when you're actually getting soft commitments, just take 50% of them right off. So if you need 500,000, you need $1 million, you know what I mean? And raise it to $1 million. It's a much easier call to tell people you don't have room than to call people frantically, and it's also much more professional. You know what I mean? It's also great when you're like, listen, I'm going to take less money from you because we need less money, and I've had that happen before. You're like, I can take 75 here and 75. You know what I mean? That is a much better morning than you're having than when you're like, I got to find another 75 or 100, whatever it is. So I think it's just these things going forward, it's much harder than you think. Raising money is very difficult in the beginning. Maybe some people come off and say it's easier. Yes, if maybe you came from a very high level C-level job somewhere, and you had people that are accredited investors all around you that trust you and you've had relationships with them for decades. Yes. But for an average investor that's never raised money from anybody else, which was myself, someone that successfully had invested for 13 years prior to that. But I mean, how do I show? I mean, I don't have audited financials from I can show you some tax returns, but I don't have like property financials from you know what I mean? I mean, it's a mom and pop investor. So it's much different than having now you're like, okay, this is what we achieved on each of these deals. And I can show you my bank statements as a passive investor and show you how my returns came in too. So you can prove that. And, it's difficult when you're starting off, even if people know you, they just, you know what I mean? And if I would imagine it's even harder for people that are coming from another industry so that have never really been in real estate for multiple years. So it's difficult without that track record. Yeah.
So no, I'm glad we covered, well, I mean, I don't know, if we can take a moment and talk about the unideal scenario, which you're going into, the scramble, when there's people out there that can sort of smell desperation. What was your kind of order of operations? And because we've had a lot of guests on the show where we talk about, raise capital before you need it. Start the process as early on as quickly, as early on as possible, because relationships move at the speed of trust, and it's the best time to raise it is when you don't need it. And we've covered a lot of that. But the order of operations, if there's somebody listening to this that gets into this sort of scramble mode, what is the exact order of operations for doing that? What are the talk tracks and the sequencing that you would do to kind of like that you use to get through this kind of like in this survival mode.
That's another great question, Matt. So I'll tell you what I do when I'm coaching people, and most of the time when I'm coaching people that are new investors, as you've heard before, like I really stress, and I kind of feel uneasy if we're raising money in the first deal, right? It's like let's not do that. That's not no, and it's not fair for the people that you're like talking to either. Like let them go out and buy like a REIT or something. They're going to get a better return and a better pleasant experience. But it's like if you bought a deal and you like it and see it's like I should have started building out an investor list after like my second property. You know what I mean? And I think just building out the investor list and being like, would you be interested in investing in real estate in the future? And they're going to be like, most people are going to say yes. And you can, at a bar, no problem, text you your address, email address, and you put them on a mailing list. I wish I had all this stuff set up I could send out. Now we send out a weekly newsletter, but back then I could have just done a quarterly or monthly, just about real estate in general. And that's building, like you said, that's building trust that can be duplicated very easily. Because now people start seeing you doing deals and doing stuff, and you're building trust. I'm not asking for any money at this point. I'm just doing my own deals. When you're ready to, you're already a lot farther down in the process, right? Further along. And I think people start raising when they're like, oh, I did these deals. Now I'm going to start like syndicating property. Okay, so what have you done? Well, nothing. I've done this. So I'm like, listen, like we're setting up like a CRM. We're doing this. Like we're getting this all like this is how you're going to set it up. This is what you're going to do. And, all that stuff. And I think that's one thing common that I've seen with investors, because some investors I work with that have like had a duplex here or they're house hacking here, but they haven't gone to the second one. And I'm like, hey, this is where we're like set up the CRM, start like tracking people. You can make your spreadsheet there, but like transfer that spreadsheet into like something more professional. If this is like really what you want to do, or you feel it's something, it's much easier to just turn it off down the road if you feel it's not. But like once you get like a proof of concept, and it's like, that's why I think, start that, really farming process for investors much earlier. And then when the email comes out for a deal here or there, they're gonna be like, whoa, what's this? What's this coming out? And it's just it's just a blanket email. No one has to respond. You know what I mean? If you don't want to. And you're gonna say, oh, he's doing deals. This is interesting. And now you're in a different light, because now you're doing deals. You're asking for money from people from the group, and they don't know how many people or how few people are on that list.
Absolutely. So, Charles, we're getting to the end of the show here, but I neglected to talk about the capital stack on this deal. Like, what was the acquisition, rehab, business plan, and then what was the how much equity did you have to raise altogether, and then what was the outcome on this deal as a case study?
Yeah, so I will never forget the $1.8 million that had to be raised for this first deal, and I think the property was $3.6 million, and we raised 1.8. So we raised a lot of the construction budget up front with that, and we ended up selling it, and it was a 23-point-something% return IRR net to investors, and it was like a 1.76 multiple. So I mean, it was great, but obviously, I mean, you don't have to be a genius to make money if you bought before COVID and sold after. But it was maybe if you sold too much after, but it was that's what it was. I mean, and it was a good deal. I mean, it was a good deal. It was older. I don't buy properties that old anymore. We've really re-honed what we're doing and working. Really, it's 1980s or newer, and it's maybe C+, but really B- and above type properties. You know what I mean? They have to be in that. It makes it much easier sale. It's a much less volatile asset. And you have to know, too, about the asset that you're trying to put people into when they're investing. Better assets are going to be more expensive. You're going to get less doors out of them. But usually they're easier to manage, and you're going to get more appreciation with them. So, that's another thing people do. And that's the first thing I look at. I'll pull that thing right up. Any property that comes sent to me for an LP investment or anything, that's the first thing. It just goes right into Google Maps, and then I pull up a couple other things for checking out like income for that area and all that stuff, and you can see where everything is, and you go from there.
Yeah, my little orange Google man is very, very much abused. I've dropped him onto the pavement many times on markets I've looked at across the country. So 2 more questions, and I'll let you go because you've been generous with your time. First one is, For the investors out there that own a small portfolio, that want to scale into commercial, what are some actions that they can take today, this week, this month to better position themselves to then take that next step in their journey?
Oh, number one, if you feel in the future at all, you're going to be raising money from investors, set up your CRM, set up that. We use Active Campaign. That's something that we used. So whoever you want to use, that's number one. Number two, set up that website. Goes hand in hand. Website, use the email address, like put on a more professional facade. It's going to make it much easier. And then start documenting everything you did. You might have like a post here or something there. Like put everything together in like a booklet and have like a credibility book that you've done. Here's the deals I've done. Here's this. These are people on my team. This is like what my whole goal is. These are the markets. This is what I really want to focus on. And I think having that all one place, and then also putting together a criteria sheet just for, like, we have a criteria sheet for syndications, and we have a criteria sheet for like joint venture opportunities. So like when we're buying properties that it's just myself and a partner or whatever it is, a couple people that are buying it, we have different. So when I go to a broker, or when we like want to hone it and like know exactly like this is it, like there's nothing outside of this, and that way you can really focus in, and it's much less stressful because you're going to see less properties, but they're going to be much closer to what you want for whatever reason.
Absolutely. That's money advice. Charles, last question is, if people want to learn more about what you got going on at Harborside and you and your business, where's the best way to find you?
Yeah, so everything about myself, the podcast, YouTube channel, everything, joining our investor club, it's all on harborsidepartners.com. So if you go to harborsidepartners.com, sign up for our newsletter, sign up for our investor club, whatever works best for you. And hopefully we can get on a call together here in the near future.
Yeah, it's Charles. Thank you so much. I appreciate it. I look forward to seeing you in the green room, man.